based on the same move going up to the high. And this is using Fibonacci extension, and say it pulls all the way down to the 50% mark. Now we can carry that forward. So where's the next move after that? As it starts to find support and starts to move higher, you could move in. It should go to 117 and then 151.
Let's see if it goes down to bounce on that 50 to 1. If it does and it comes back up, then it's more likely to go above the 100 to 1. If it doesn't and it continues going through that level, then it's more likely to test that bottom ratio again. So that's why pattern shifts, and I talk about them all the time, because they help you see what is the next most likely outcome.
The path to triple-digit silver prices is contingent on a critical technical milestone, the 50% retracement level. According to Fibonacci extension analysis, this midpoint is the decisive support zone that validates the entire bullish structure. If the metal can successfully test this floor and bounce, it confirms the momentum required to unlock higher extension targets, specifically $117 and $151. However, this is a strict condition. The market must respect this support level to maintain the statistical probability of an upward continuation. Chris Vermeulen, founder of the Technical Traders, joins Lynette Zang to deconstruct this pattern shift, explaining that the market is facing a binary outcome. They highlight that failing to hold the 50% line effectively breaks the trend, flipping the probability toward a retest of the bottom ratios rather than a surge to new highs. This dynamic shift helps investors identify the next most likely outcome without guessing. By waiting for a confirmed bounce at this pivotal threshold, traders can distinguish between a healthy consolidation and a dangerous reversal, ensuring they only enter when the path to $151 is technically secured. Now, we present the clips from Chris Vermeulen and Lynette Zang's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Just to use a Fibonacci retracement, meaning it's going to tell us, on average, the momentum, how the mindset works, the universe works, is going to tell us where price should go. So we could take a couple different levels. This is a fairly significant standout low before it ramped up. So we go from this low, and this is going to go all the way up to the peak of 106. And so it's saying that silver should or could, the most, a healthy pullback would be into this range. So that's $62 to $72 an ounce. If it pulls back deeper than that, it starts to do some damage to the chart, and it actually starts to put in significant overhead resistance. I won't get into that. But long story short, that is the sweet spot, that if it pulls back into there and starts to stabilize and then starts to move higher, that could be a point you could get back in, because after that, it could go a whole lot higher. And just based on the same move going up to the high, and this is using Fibonacci extension, and say it pulls all the way down to the 50% mark, now we can carry that forward. So where's the next move after that? As it starts to find support and starts to move higher, you could move in. It should go to 117 and then 151. But you don't have to suffer this, buy here, ride it up, and then watch it crash 20, 30%, and then put in all this time for it to rebuild again. You could just, I think the best thing to do here is to let it see what it does at 106, and if it blows off and reverses. But this is the sweet spot. If we, that's where it should find support if it settles back down into that space. If you have FOMO and this thing's ripped up, you're like, I didn't buy it at 60, or I didn't buy it at 50, and now it's at 100. I lost money. It's a terrible mindset. You can't look at the markets that way, or you're always going to feel in pain, and you're always going to be upset, and you're always going to be chasing things. So if I scale out of positions. Now, I know enough about the markets that I know there's going to be a very big peak here at some point. I don't see the final signs just yet. I believe we're very, very close for me to start trimming off and selling some of my metals positions. But for the average trader, as you were just saying, like somebody who's watching it go up and they want to get in right now, honestly, the best thing to do, especially looking at this chart, it doesn't matter if it's silver or not, something that's gone straight up like this, you got to just wait for it to have a pullback or pause. It's got to build a new launch pad. You got to let some of this momentum burn off through sideways time on the chart or through a pullback, and then you could re-attack it. But jumping in here, at 94, sure, you might catch a move up to 130 or 120 if it spikes. But if you're that type of person who got in here with that mindset, you're also not going to sell it when it hits 120. So you're going to ride it down anyway. So it really just comes down to, you have to have a game plan. You have to not be trading based on how much am I missing and other people making without me. It's got to be like, how can I navigate this with my position and have a stable mindset of how you're going to attack it. And it really just comes down to that. Unfortunately, most people just look at the markets through the wrong lens. They let their emotions kind of take over, and it gets them on the wrong side simply because of that.
We see more of a shift toward gold as the primary currency metal. And when we're looking at where we are today, or at least when I pulled this on Friday, we were at a 58-to-1 ratio. So it's dropped very substantially, because there are times when spot silver is moving faster than spot gold and vice versa. So we're going to look a little bit more deeply. So we get rid of the 15-to-1 piece, and now you can see this a bit more clearly. But I also wanted to show you the average over that time, and the support levels. That's what I'm showing you here. See, that broke a support level. That's why I circled it. And it did it again there. It hit. All right. Let me kind of back up to do this a little bit more clearly. Technically speaking, support is on the bottom. So you see that ratio hit the bottom and then bounce back up. Resistance is on the top. So it hits the top and it bounces back toward down again. When you see a pattern shift, is because it either goes below that support level, which means it's likely to go lower, or it's going above the resistance level, which means it's more likely to go higher. So that's why I wanted to show you this, because where are we right now? What can we anticipate? Let's get there, right? Because look at it, it broke that 50-to-1 ratio back in 2011. Right now at 56-to-1, or wherever we were, I think it was 56-to-1. I would imagine this would be telling me as a technician that, because at the same time in 2020, we broke the upper resistance level, right? So quite honestly, it's telling me that it could either go back down and test that 20-to-1 ratio, and it could go back up and test that, it'll go past that 100-to-1 ratio. We don't know. Time is going to tell us which way or the other, but we can pay attention to where we are right now, and at 56-to-1 or 58-to-1, whatever that ratio is telling you, let's see if it goes down to bounce on that 50-to-1. If it does and it comes back up, then it's more likely to go above the 100-to-1. If it doesn't and it continues going through that level, then it's more likely to test that bottom ratio again. So that's why pattern shifts, and I talk about them all the time, because they help you see what is the next most likely outcome. I can't give you any guarantees, but frankly, when I go to these technical levels, it really doesn't matter what you're looking at. You could be looking at stocks, you could be looking at interest rates, you could be looking at confidence levels, you could be looking at ratios. It doesn't matter. What you should always be looking for, and it's simple, you could just take a ruler, a straight edge, right? Pull up a chart. Put a ruler to it. You can see for yourself. It's not rocket science. It's actually really simple to do. Print out that chart and just draw a straight line down whichever direction the lines are going. And then that helps you understand what is the next most likely outcome. We're going to know this soon because it's testing that level.
The gold to silver ratio is currently testing a decisive historical threshold near 58-to-1, marking a potential pattern shift in the metals market. Technical analysis identifies the 50-to-1 level as the critical line in the sand. If the ratio crashes through this support, probability dictates a retest of the 20-to-1 valuation, signaling a massive repricing of silver where it significantly outperforms gold. However, if support holds and the ratio bounces, the trend favors a reversal back toward 100 to 1, indicating gold's return to leadership. Investors can navigate this volatility by looking for specific breaks in support or resistance that reveal the next most likely outcome without complex forecasting. Whether using sophisticated software or a simple ruler on a printed chart, the principle remains the same. The direction of the break dictates the future trend. We are currently watching a live test of this level, and the market's reaction at 50 to 1 will determine the liquidity flows for the coming cycle. Let's get back to the interview.
3 digits, triple digits for silver seemed pretty crazy, 4 or 5 months ago. And here we are, probably going to blast through the $100 mark for silver. And here's the thing, you made a good comment there. You said, people waited 40 years for silver to finally break through here. And then suddenly it has this in 3 months, it just goes absolutely ballistic and goes straight up and hits those levels. I mean, it took 40 years for it to build a base and work itself out and get here. It's not like, yes, it unfolded very quickly, but overall, the speed that it happened, I think, is going to catch a lot of people off guard. So because in 3 months, people have gone from, I've had 30 and $100 silver forever. And, in 3 months, it's now worth triple that. It happened so quick. People think now that the silver run and the precious metals move here is just beginning. I actually see it the opposite. I think we're actually going to see a continued blow-off move to the upside in pretty much all metals. But I do believe time-wise, we are very close to a significant standout high. And I mentioned this earlier. Everyone seems to be moving in. Whoever's open to buying precious metals, that's the everyone, is buying it now. Who have always thought about it and wondered about it, they're now starting to go to the general stores, the retail traders, and buying. Retail individuals are buying it. And so the fact that it's moved so quick, so fast, feels great. There's no doubt about it. I'm heavyweight in silver over gold myself, but just because it's happened quick doesn't mean it's the beginning. It doesn't mean silver is going to run for another 10 years. I think it's quite the opposite. And the market usually tops out when people least expect it. Just as everybody gets excited, the music stops, right? It's like fluorescent lights go on, cops pull up, party's over. It's like, that's where I feel like we're heading. And it's been very similar to, we'll just flip back quickly to GDX, for example. GDX, we go way back to the miner space. I think a lot of people can relate to this. People got into miners in this whole move up leading into 2011, 2012. And they had to put in a very, very long, painful thing. And really, the reality is, we've only seen a very quick move up to new all-time highs in the miners. And again, people still think it's just the beginning of a very long cycle, but I believe, we're actually coming more into a bit of a peak. So let's flip back to silver, because I have a $106 per ounce target on silver, which I think we are going to hit probably from the momentum in place, really, maybe even this week. So if we were to just take a look at this last big consolidation in silver, we take the low, we move up to this standout reversal, this pivot high, and we come back down to this low. It's going to give us our two levels that we always follow, or that I always follow. Those two levels are the 618. That's the 61% extension. It's called the golden ratio, the Fibonacci golden ratio. If you move to that level and price has a little bit of a hiccup, which it has, we almost always go up and see price hit the 1 level, which is the 100% measured move. And so that is at the 106. So that is what I'm expecting to hit most likely this week, just based on the daily chart and the pattern here. And after that, we could see a couple of things. We could see price go ballistic and actually have a little bit more. I say a little bit more. It could have another big blow off phase. It could go up to 120, 130. Huge green bars. It absolutely gets everybody into like this feeding frenzy. But then it could have a very, very sharp reversal and actually put in a peak. Right when people think it's just getting going, it could be coming to an end temporarily. And we've seen this before. Like, for example, we did a trade in silver, just a short-term extra trade. We got into silver. I can't remember exactly where it was, somewhere right in here. And we sold out right here, I think. And we also did this for similar to gold. We caught the easy move. And then once you hit that Fibonacci 100% measured move, it goes into a volatile feeding frenzy. It's unstable. You don't know if it's going to just get hammered or if it's going to spike up and chop around. And of course, we've had another long trade in the precious metal space. We're long again. But that's what I'm expecting is we're going to probably see gold and silver hit their 100% measured moves very quickly here in the next week or two. And then we could see a big blow off phase. It could go even higher. Silver have a big spike, gold. But if we do get that big spike from those levels, that to me is going to be the trigger like, hey, I might actually be looking to actually sell and trim off some of my physical metals. Because when we get into one of these scenarios, usually we get into a very, very sharp correction. And silver is a pretty scary looking chart in terms of that. What goes straight up, likes to come straight back down for at least half of that move. And so if I clear the chart, we could see silver spike up into the triple digits, and then it could easily come back down into the 60s, 50s, or even the $45 range very quickly. Now, people don't want to hear that. I'm going to take it on the chin for that, but that's what I think is going to happen. And because everybody's going to jump on me for saying, silver's about to put in a big blow-off peak and probably have a sharp knee-jerk reaction, that is also a signal that most likely it's going to happen. And that's what we see whenever things get like this. Man, you can't say anything bad about the space or you get torn to shreds.
If you're thinking about doing this as a trade, pay attention to, and you have the links to everything anyway, so you can actually even go onto long-term trends and pull this particular chart. See if it breaks below that 50 to 1. If it does, then it's more likely to go down. If you're thinking about this as a trade, then this chart is the one for you to pay attention to. If, however, you're thinking about it like a strategy, which is the way I think about it, then what I'm really looking for is function. And the problem is since there is a finite amount of gold and a finite amount of silver, you want to make sure that you have the right kind of gold and the right kind of silver to perform whatever it is that you are wanting to do. And so, that's entirely up to you. We at Zang Enterprises are here to support any and all of your efforts. Even if we can't actually execute that piece for you, we're going to do our best to give you whatever tools you need to make those educated choices and to help you. But I suggest you give us a call and you have that conversation. And remember, we're going to put your goals first. If your goals are trading, we need to know that. But this is probably not the right thing for you if you're trading, because you don't want to do trading with physical. It just doesn't make sense.
The impending market volatility, characterized by vertical blow-off moves and subsequent 50% corrections, poses a lethal risk to investors who confuse trading with strategy. As silver potentially blasts through the $100 mark in a feeding frenzy, the speed of this repricing is likely to catch the majority of the market off guard. While technical indicators like the 50 to 1 gold to silver ratio provide a precise roadmap for capturing short-term alpha, applying these high-velocity tactics to physical bullion is a fundamental error. The logistical friction, premiums, and illiquidity inherent in physical delivery make it a disastrous vehicle for short-term speculation. Therefore, investors must decide now whether they are gambling on a paper price spike or securing a finite asset for long-term survival. Analysis concludes by drawing a sharp line between the trade and the strategy. Trading with physical metal doesn't make sense due to the inefficiencies involved. Instead, the focus must remain on the asset's absolute scarcity. Because both gold and silver are finite, the strategic goal is not to time the exact top of the bubble, but to ensure possession of the right kind of metal suited to specific financial objectives. At the same time, charts identify the when, the what must be governed by function, ensuring that wealth is preserved in a tangible form that operates independently of the chaotic noise of daily price fluctuations. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.